And we're live.
Welcome.
Rolling. Yeah, welcome.
Hope you had a great weekend. But today is Monday. The what?
Yeah, today is, well, that's my line. You're walking all over my line here. Today is Monday, February 24th, 2025. And this is Momentum Mondays. This is our podcast.
This is where we break down the latest.
Yeah.
Oh, I'm sorry.
Go ahead.
No, you told me not to read word for word.
Yeah. Anyway, we break down the latest market moves, economic data, and what's on the horizon. And we are coming to you via video and audio this week. Last week, we announced we were publishing to audio platforms. So if you missed that, I'll put the show, whatever you call it, the show image, the key image or whatever, I'll put it up here. This is what you're looking for on the podcast platforms, the audio. And then I will throw it over to you for the disclosures. Now, make sure, you have to be really moderate about this because we have people that are only listening to the audio.
Yes. So note the content shared in this podcast is for informational purposes only, and it should not be considered financial advice. Always consult with a qualified advisor before making any investment decisions, such as ourselves. MomentumWealth.us.
I think there's a happy medium that we could get to there, but we'll work on it next week.
All right.
It's something to look forward to.
MomentumWealth.us.
Anyway, let's look at market performance from last week of February 17th, 2025. It was a short week in the market because, of course, it was President's Day last Monday.
How did you celebrate?
Not open. Well, I was here for a little bit of time doing this. And then we, I don't know. We played a game about the president. I don't know. I mean, what do you do for President's Day? Anyway, let's take a look at the indexes. This is kind of interesting. Week of 217, the S&P was down 1.6, NASDAQ down 2.2, Dow down 2.4, and the Russell just got obliterated, down 3.62 last week. But if we change over to the commodities, you got gold up 1.67%, silver up 0.96%, which was very close to what it was up the last week before last. And then 10-year bond up 0.42, Bitcoin up 0.83. So if we take a little breather here, last time, it's been a while since we've looked at year to date, but if we pull up year to date and check that out, we've got S&P up 2.36, NASDAQ up 2.9, Dow Jones up 2.2, Russell down on the year, 1.43. Very interesting. The Russell 2000 is an index that we've been talking about for a long time, and it's not doing anything. What is going on with the Russell 2000? This is wild.
Don't think about it right now.
It's wild. Then you got gold up 11.82% year to date, silver up 12.38. Our 10-year bond is up 1.69, and Bitcoin's up 3.99. Now, of course, the market is open today as we're speaking. This is going to be as of Friday's close. So, I don't even know what the market is doing right now. Are we up or down or flat?
The NASDAQ's down 1%.
Okay.
Russell 2000 down a little bit less, and the others are essentially flat. But it's the Russell 2000. It's been teasing us going back to summer of last year, and
normally you get a little bit of capitulation during the first part of the year, where there's a lot of optimism, especially for small companies, which is what the Russell 2000 is. But we're not seeing that this year.
Well, I mean, we are up. What, 10? Well, I mean, we're up 20% since. Okay,
in the Russell.
That's the wrong date.
No,
that's the wrong date. We're up roughly 10% year over year.
7.5 over 1 year.
Yeah. So,
but you got the S&P is beating that out by almost 4.5%. So, I mean,
we want to see the Russell 2000 do well because that's telling us that the bull market is not only sustainable at its current pace, but it's got a while to go. So if I had to predict, and I was wrong, obviously, and seeing, post-election, Russell 2000 did hit hard. I mean, we looked, after the election, it went up from, well, let's just say it's 10%. It was 10% higher than it is now.
Yeah, but it has a wave. I mean,
pull that up.
Pull it up.
But I think
1 year.
I think it really comes down to.
Yeah, it shot right back down. So we had a period of time from about November 5th to December 16th where the Russell 2000 was up 4.5%. And then we are essentially right now with the Russell 2000, we're back where we were back in October of 2024.
Yeah.
So we've basically done
Yeah.
nothing that whole time.
Yeah. And I just think that we're going to have to get past what's going to happen. The biggest impact to the Russell 2000 is tax policy, trade policy, those two biggest things. And in some way, they could cancel each other out to a degree, but we do have strong small business sentiment. We have strong consumer sentiment. We have people picking up. In fact, I think it's the Rasmussen reported last week, the first time in their daily tracking on right track, wrong track direction of the country, that the more people answered in support of right track since the year 2000.
Wow, that's interesting.
Yeah, it's very interesting.
Trump's approval rating is the highest it's ever been. And so a lot of people are attributing that to sort of the honeymoon phase, but I'm not really sure if that can be attributed to that or not. It's got probably a lot to do. He's obviously very divisive, and we've talked about this a couple times before, so I don't want to belabor the point, but everybody knows that it's sort of divisive, everything that's going on with Doge.
Well, you would say it's divisive, but say today I was looking at the Harvard Harris poll released today, this morning, 2,443 registered voters, and it said what you stated about the approval rating. It's up a lot. Then you look at comparison to Biden, it's a big difference. Now, here's where it talks about the policy support. This is interesting. Early actions seem to resonate strongly in reference to Trump's early actions. 81% back deporting illegal aliens who have committed crimes. 76% support cutting government waste. And there's a few others, but that's the biggest. And and it's not, it's like 76, 70, 61. These are huge amounts, but the biggest one that I saw was like, what? Because most people would agree if somebody comes here and commits a crime, your compassion kind of goes away, right? It's like, well, you can't be doing that stuff in the country. But 76% support cutting government waste. That's 3/4 of voters are saying essentially to Trump and Elon, get after it.
Yeah, because they're seeing the effects of it on their wallet in real time, and the fact that their wages are not keeping up with what's happening with, eggs is the common example, but that's a whole nother issue.
Oh, I did see what they're doing to address the egg. And we've had a lot of clients, and I've talked about it. I mean, it's crazy with the egg prices. And that's got to be a thorn in the side of the administration who got in because they wanted to do lower prices. But,
they had no control over it.
Well, I know. Well, here's the thing. Here's the thing. The government.
Slaughtered birds.
Well, the government's telling them to slaughter it. You notice the price of your chicken is not going up. Well, why is that? Well, because you're eating the chickens that they're slaughtering that they had to kill in coal that were laying the eggs. So if you. Yesterday it was announced that, or over the weekend that is, it was announced that they're going to be trying to not do mass cullings as much. Now, there's risks to all these things, but I think that the government for years, decades, for generations has been very heavy-handed in forcing farmers to cull or recommending that they cull livestock for one reason or another.
Well, there's a lot of examples of that.
Yeah.
All through decades.
Yeah. And even go back to the Depression where FDR had them, slaughter like 500,000 pigs.
Yeah.
They were starving people in the country. And it's like, well, pig prices have dropped too low.
Yeah.
Deflation. We got to fix that. Remember, the government hates deflation. We talked about this. The government hates deflation.
Why do they hate deflation?
Because it makes them pay back the debt they've borrowed with dollars that were worth more than the ones they borrowed.
It's sort of the opposite problem that we're having now.
You can see it runs both ways, where too much inflation is bad and too much deflation can be bad, but it depends on the type of monetary system. But all that being said, you end up with right now the problem is because of interest rates have gone up in response to excess government spending, which created inflation. Now the government cannot afford the interest payments on the debt. Having a conversation over the weekend with someone, trying to wrap their head around, well, why did Trump, who spent a lot, he spent about what Obama spent during Obama's tenure the first time around. And you have to I will give Trump and Biden forgiveness on what happened, say, March of 2020 all the way to March of 21 or the summer of 21. That was like wartime spending. And should it all have happened? No. But, during that moment in time, the government felt the only way to keep everybody from going bankrupt was to just helicopter cash to everybody's laps. So if you take that away, the only thing that's different between why it would seem that the Trump administration didn't care about spending And why the first part of the Biden administration didn't seem to care about spending is because they were borrowing money at virtually 0% interest rates. And we had the greatest. Now people will say, well, interest rates used to be higher in the 80s. Well, yeah, they did, but
We had like
to
10
go,
years of zero rates, though.
well, yeah,
I
and
mean,
that's a big difference. And if you go from 5% to 10%, that's just doubling the interest rate, right? But if you go from 0.05 to 5%, that's a 1000x or whatever. I mean, the rate of increase is the greatest it's ever happened in the country before. So when you're borrowing all this money at virtually no interest, and now your interest rate has gone up to 5%, you're going from spending 150 billion a year in interest only payments to spending a trillion a year in interest only payments. And within about 36 months, that's going to go up probably to 1.5 to 2 trillion if they don't stop it and get the interest rates down.
yeah. Well,
So
that's what they're trying to do as far as Trump's focus. That's a good segue into talking about something that we do look at, which is what we just talked about. Basically, when we track these, we're tracking just a couple of indexes when we go through the returns of the week that was. And one of those things that we track is the 10-year bond. Sort of a conversation. We've had a lot of questions about it. Why do we track the 10-year bond? Why do we care about the yield on the 10-year bond? So I thought it might be beneficial to have a little conversation about the influence. And certainly we saw a perfect example of that last week where the markets kind of whipsawed back and forth. And one of the reasons that did that was the 10-year Treasury yields. They were a significant factor last week. So they rose to about 4.5% on February 18th. What does this reflect? Why does this happen? And why is the 10-year yield so important to traders and investors and then overall long-term interest rates? Mortgages, for example, why does it matter?
well, most of your important financing is tied to the 10-year.
Right.
That's the benchmark. And you could ask yourself why. And the simplest way to look at it is if you're an investor and you have $10 million and you can fund and or increase the supply available of mortgages with your $10 million to the public, you're going to increase the supply, which is going to decrease the rate of interest. If you have the option to do that at, say, 4%, or you have the option to just give it to the federal government with a guarantee to get 5%, why would you take the risk, right? Now, where things start to get a little uncomfortable for financing the deficit is if investors, just like you would say, let's say mortgages, the economy is going south, you're not really sure mortgages are going to be paid back, you're going to demand a higher interest rate for that risk. Same thing with the federal government. You're going to look at it and say, well, if I am going to buy treasuries over mortgages, if I'm going to supply the US government money, or am I going to supply the private sector money, I want a higher rate of interest because you people are spending like drunken sailors. And I can do the math, and you're either going to have to tax the people more, which if you do, they'll vote you out of office, or you're going to have to cut spending. So right now, I feel uncomfortable unless you pay me 6%. And so you have this tug of war that's going on, which is why it all is coming down to the U.S. government is spending at wartime levels. It is significant. And if they bring it under control, 10-year treasuries will come down because people will be more confident that we're not going to have a debasement with the
Well, it's also
currency
a
that takes place.
forward-looking metric. So when you look at the 10-year yield, it generally tells you what the forward-looking economy looks like. Either people are okay with the amount of growth that's going to be projected to come, or they're concerned, and you see the yield kind of fluctuate based on that basis. And the correlation between the yield and the price, which is that when yield goes up, price goes down, vice versa.
Yeah.
Price goes up, yield goes down. And this is sort of the relationship between those two. And so what you would normally look to see, and we talked about it before, which is when you're in the middle of a rate cutting cycle with the Fed cutting rates, which we've been in for, has it been a year?
Yeah,
A little
probably.
less than a year.
Something like
So
that.
we've had 100 basis points of cuts. And so everyone was expecting the mortgage rates on 30-year mortgages to fall in correlation with the rate cutting cycle. What we saw was not that. The opposite happened, actually. When they started cutting rates, you saw the mortgage rates actually going up. And now we're back to where we were about a year ago with mortgage rates. We really haven't made any progress. And so why is that? If you're looking at 10-year yields and you're expecting them to go down when the Federal Reserve cuts rates, why did it go up over the past year?
Yeah. Well, it can be, normally these things are made aware after the fact. You can always go back in time and see, well, this is what happened. You could pontificate now and say that a lack of confidence in the U.S. economy going back to, 2023, 2024, a lack of confidence in the U.S. government being able to constrain itself. There was a lot of unanswered questions when it comes to the tax policy before the election, who would win and what would happen with tax policy. Because, if they let the rates go, the tax rates go back to where in 2017, that's going to hit people hard. That's a big deal. And so, you have interest rates in the Fed, you have inflation, the expectations of inflation, you have economic growth, you have global demand of treasuries, you have risk sentiment. You also have to understand, too, that when the war in Ukraine started, the U.S. government did something very foolish. And that was they weaponized the dollar in sanctions against the Russians and stole their dollar reserves. They took their dollar reserves, 600 billion, I believe, with a B. Who wants to hold dollars if the U.S. government can just come and press a button on the SWIFT system and take it from you? So those aren't, and those actually aren't dollars. Those are treasury bills. Those are generally 10-year treasuries, 10, 20-year, 30-year treasuries. So if you have a decreasing demand for those treasury notes, those treasury bills, then you're going to have upward pressure on rates because people want to be compensated more to give you more of their money. And that's a big deal. And also, it's one of the, I was not aware until recently that all of the money that the European countries gave Ukraine, they had a guarantee to get paid back.
Right.
We know how they were getting paid back with the interest on the treasuries that they took from the Russians. So now you have this whole little cycle of craziness, of unethical behavior for the world reserve currency. That creates problems. And I think that's why you're seeing so much adoption and such a large push for providing clarity and regulation for stable coins, because that is one way to increase the demand for treasuries, which would decrease interest rates, is for all the stable coins to be, by law, mandated to hold dollar for dollar reserve assets with treasury bonds, treasury notes, treasury bills. So they got to replace that
uphill battle. Then.
They got to replace that demand, because do you think the Chinese are increasing their treasury holdings after watching that? No. And you have to have that demand in order to keep rates low.
Well, I think the other thing is uncertainty, because you have the Federal Reserve cutting, and you have sort of the economic growth outlook being adjusted upward. So a little bit higher growth, but then you have sort of sticky inflation. Every time we have a PCE or a CPI rating, it comes back a little hotter than we expected. It's in the news. We've got another one coming up on Friday we'll talk a little bit about. But these metrics kind of come back a little hotter than expected, and so it gives the investor, we don't know what to do. We're stuck in the middle. If you use a baseball analogy, if you get stuck in like a rundown where you're trying to run from first to second, and the first and second baseman get the ball and they're throwing at each other trying to tag you, that's kind of where we're at right now, and that's why the yield on the 10-year keeps going crazy. And so there has to be some sort of capitulation moment to figure out which way it's going to go. And I think right now it's just nobody knows. And that's why you've had in this period of time where you're just kind of meddling about, because it's so confusing to everyone. Even people that do this all the time, they're like, I'm seeing competing metrics. I'm seeing growth a little bit higher than we had expected, but I'm seeing inflation a little bit higher than we expected. So these two things don't mesh well, and it provides a lot of uncertainty. And then the Federal Reserve saying we're going to pause rate cutting. I think that the general consensus was that the rates would be lower before they decided to do that. And so that's another kind of wrench in the process, is where we're not quite where we thought we were going to be. We're not even quite where the Fed thought we were going to be, according to the plot, like the dot plot. So it's a lot of different things, but it's an interesting conversation about why the 10-year is so important.
Now, I will say it's going to go down.
Well, I mean,
it will go down. Well,
for what time frame?
It depends how many people they fire in the federal government. What do you mean that you want to talk about?
Because it's directly related to spending.
Yeah, you want to talk
spending,
about that hits both sides of it. So that's confidence for investors that the U.S. government will make good on its debts and not debase the currency outright in order to pay those debts back. And then secondarily, if you fire 200,000 or 300,000 people, that's going to put a lot of softness in the economy, which is going to force Powell to also lower rates, which is going to make people think the economy is going to slow down, which is going to make them buy more treasuries because they want safety instead of the S&P. So you could have that type of event occur. But my opinion, all in all, is that, it really doesn't matter. This is short-term discussion. Long-term, I think that it's great that you have people wanting to get their house in order with government spending. I think it's great that there's so much innovation and rates. People adjust to things, right? I mean, that was a shock going from, mortgage rates like me and you got it like 2% to 7%. But, over time, even if it doesn't go back down to 2%, if it settles around 5%.
Well, the average is much higher than 2%. If you look back over historical average of mortgage, I mean, the rates when they were 2% and 3%, it's historically low. I think the average is somewhere between 6 to 8% of mortgages, like over the history of the data that they have on that, on the 30-year mortgage. But, I don't even know if I say that it would have the effect on the economy, the firing of the federal workers because they're spending less money. But I don't actually know if that's true now that I think about it, because they're going to offer the severances for those people. And so I think even then you have sort of a delayed payoff. When is it going to take effect? Because you have injected this.
Does everybody get a severance though?
That's a good question. I don't know on the answer to that. I think if you, I don't know. That would be a question for them. Elon, if you're listening, let us know.
Yeah, he's a follower of the podcast. He's no, just kidding. But no, it's all very interesting, and it's interesting to look at in the short term. But I do predict that one way or another, the forces of the economy and the forces of government are moving. They are targeting, almost as if they were working together. This magical hand. They are targeting that 10-year, and I predict they are going to get that down. And in doing so, risk assets will do very, very well. That is what I predict. I think that it's going to happen.
The investor is going to go wherever they make more money. That's the gist of it. Mm-hmm. That's the end all be all. This is the same case with real estate investors. While you saw the real estate market kind of fall as the interest rates were rising, because if you're holding a real estate property for income and you're making 4 to 5 to 6%, and then you can make the same amount of money in, the bond market or an interest-bearing savings account or something like we saw, you're going to have a whole lot of people dumping those properties and moving to something that doesn't require as much work. And so you saw that happen, which was sort of an interesting correlation. But so the 10-year yield, that certainly was one of the effects of last week, of what happened last week with the index movements. Another was the corporate earnings and guidance. We saw a lot of companies that came back sort of in a place that we didn't expect. You had Walmart, NVIDIA. Let's see, let me pull this up. Last week, you had Microsoft, Walmart, NVIDIA, Tesla, JP Morgan, Microsoft. All of them were down last week. And I think all of them announced earnings. So that's going to be downward pressured on equities. Cautious outlook for consumers on how the forward-looking market is going to look. You have some Fed policy expectations. We've got some Federal Reserve Board members speaking this week, so it'll be interesting to see what they say based on sort of the unexpected thing that happened in the earnings last week. You've got some geopolitical risks. We've got some sector rotation going on.
Yeah, but what does this tell somebody that may be sitting on the sidelines trying to make a decision that's not 105 years old, that's sitting on the sidelines and maybe looking to allocate capital? This could be a great opportunity when you have this kind of short-term weakness and the indexes can't seem to catch a bid past a certain point. What's the historical significance to that as it relates to buying opportunities?
That's a very good point. Historically, we have a lot of weakness at the end of February, and that's the overarching thing here, is that this is not uncommon. This is not unexpected. It's not out of left field. It's sort of going right along with what happens at the end of February and there's a number of reasons for that. Taking profits. We sort of have a tailwind at the end of the year into January, and it continues on through the month. And so people feel like they need to take profits at certain points during February to kind of lock those in. So there's a lot of things going on. I mean, it's very interesting. But if we take a look at kind of what we're looking at here in the next upcoming week as far as earnings reports and stocks, we've got Apple that's going to report earnings. That'll be interesting to see. They are focused really heavily on the AI space, which I think they're probably one of the worst at. So I would like to see what that looks like. Nvidia has earnings. See what they're reporting. We got Target is a good indicator of consumer spending. So we're going to be watching Target very closely, the sales trends and the guidance to see what the consumer is actually doing. We had a kind of soft consumer spending report at the beginning of February for January, and we were kind of discussing between ourselves that might be because of the Christmas season being so great that people kind of backed off New Year's resolutions. I'm going to spend less, I'm going to save more money, yada, yada, yada. Salesforce, we've got them reporting. Be interesting to see the tech sector sentiment there. Cloud software, AI adoption, ExxonMobil, oil market focus. We do have an oil specific indicator that just went in yesterday. So it had been out for a little while. It doesn't really affect any parts of our portfolio, but it's interesting to see sort of the buy signals for oil. Again, not advice. Do your own research. Reach out to financial professionals to help. But it is a market that we're looking at. So I already said multiple Federal Reserve officials will give speeches this week, and the PCE is coming on Friday. So this is a key report for consumer spending and inflation, and the Fed closely watches this one. So it's going to be critical to determining if inflationary pressures are still there.
Yeah, it's going to be very interesting to see. Very interesting. And, I think that even considering all the geopolitical risk, all the global economic concerns, you had elections overnight in Germany. They're having a big change in government, big shift in government. I think there's a lot of changes on the horizon. And, you can go back and look after World War II and see when you had a lot of changes and a lot of people wanting to, let go of that time period that was very difficult for them. The parallels I'm drawing here is World War II and then COVID, the shutdowns, and then the inflation. It's much different than World War II, but
from the manufacturing point too.
Yeah, so it's going to be interesting to see how these changes come out. I think that well positioned in our portfolios, we do have a prejudice towards domestic. We generally have always had. Now we are data driven, so we're not purposefully saying no international or emerging, but
we have been in that space in the past 12 months. But we came out of it.
Yeah. But historically, if you look like over the past 10 years, we've always tilted more. The data has always encouraged us to tilt more domestic. And I think that this go around, this cycle is no different. I think we have a lot of innovation, a lot of technology. There will be disruption, but technology solves problems. And when you solve problems, you make money. And I think that, I think the U.S. is in a great spot. Could it be better? Yeah, but I think that it's in a good spot, all things considered. And seeing the war end in Ukraine, mineral rights deals, I know we maybe can talk about that in a couple of weeks when we have more data. What's the impact on Caterpillar, John Deere, those that produce the machinery to mine coal and rare earth minerals? What's the impact on some of your uranium suppliers? Very interesting things could potentially come out of those types of arrangements that could strengthen supply chains in the West and provide a lot of opportunity for people to make a lot of money. Also, too, they're the largest Eurasian, I think, could be wrong, but they're the largest Eurasian producer before the war of neon gas. You have to have neon gas, Ukraine.
Oh, okay.
And you have to have neon gas when you're making microchips. I don't know why. You could ask AI, Grok, or ChatGPT, and they'll tell you as you're listening to this. But you have to have, these noble gases in order to produce these microchips and things. So very interesting.
Well, you saw also Apple announce their investment into the U.S. economy.
$1 kajillion is what it was.
It's like 500 billion. Is that what they said?
Yeah, I'd say it's half a trillion, half a T.
So this is something that Trump has sort of said he was going to go after, is these companies to reinvest in the country. And so it's positive. They've done it before. It's not the first time they've done it. I think they did it last time Trump was in office, where they built one of the Mac computers in Texas or something.
Is it kissing the ring or is it a big deal? I don't know. $500 billion seems like a big deal. It's data centers.
Yeah, but where's this going?
I think it's data centers.
It's data centers.
Yeah, I believe. Let me look.
Yeah, so that's the thing about data centers, and this is the same conversation we had about the Meta data center in Louisiana, Northeast Louisiana. Is like, how many jobs does it actually provide once the facility is up and running? You've got a lot of construction jobs on the front end building these giant data centers, but how many people actually have to be there to run it?
Yeah, I think it's a couple hundred to be there, and then as it was explained to me from someone in the know,
So a lot of
looking
these
at
are
about
short-term jobs. Is
well,
the point I'm
about
getting at.
3,000 will last for
Right.
up to 5 years, and then permanent will be a couple hundred, couple two, 300. And if you're listening and you know more than that, comment below.
Yeah,
Let us
because we
know.
were talking to a
But
client about this. Very interesting. I didn't realize that because these large companies like Meta, for example, they move these construction crews all over the country to build these data centers. They're very good at building the data centers. They've already built some. Why not have them build them everywhere? So these people that are building these things will actually, a lot of times, not even come from the local economy. They will come from outside of the local economy. But what they will do is buy homes, which was shocking to me, inside of the local economy for this 3 to 5 year period, which is
when you would think they would either travel,
yeah, I'm trying to wrap my head around that because that's the
live
opposite of
live
what I
on
would
site,
do.
which is
Yeah.
common in big construction sites sometimes that are very rural. Like if
Yeah.
you think about some of your
I don't
your
think
North
that's possible in
Dakota.
Northeast Louisiana, though.
No, I mean I think it's great. It's going to help the housing market. Now Apple's doing this in Texas, which doesn't need any
Well,
housing
same
market
thing
help.
they did last time.
But it's I mean they're looking at
It's just strictly data centers.
yeah, basically, but they think it'll add 20,000 jobs.
Over what time frame?
4 years.
Yeah, short-term jobs. Yeah, I mean, this is not really helping in the longer-term economy with jobs like that because, they're also outsourcing a lot of that. I really don't know what, I mean, they have iCloud, which is, I guess pretty popular. But as far as the AI offering, they're relying on others. And I just saw a report that they're going to actually do some sort of partnership with Gemini, which is Google's AI. So I don't know. I mean, if you use AI or if you use virtual assistants at all, and this is really painful for me to say because I love Apple and I have for many years, Siri is probably the dumbest virtual assistant on the market right now. And there's a lot of people saying that.
Oh, Alexa's better. Alexa's better. 100%.
I don't have any experience with Alexa, but
Grok is the best, in my opinion. LLM.
Well, with the new version, they're calling it Grok 3 or whatever. I think that it definitely has. I don't even pay for it. I use the free version through Twitter or X or whatever we're calling it now, and it's pretty good. But I use ChatGPT a lot too because of some settings I have set up in there. But it's all interesting, and it's all something that Apple as a company with as much capital as they have and as much resource and as much creative talent as they have typically and historically had at their company, if they can't come up with something better, is kind of mind-blowing to me. And I'll hold my tongue maybe until the developer conference this year when they announce the new operating system for this year, to see if they have maybe some sort of explosive new technology. But I don't know. It's just shocking to me. And I don't know.
And I don't think it's a problem that can be solved by just throwing money at it either. And that may have been their big mistake, is that they just knew they had an enormous amount of capital. And when they felt like it, they could deploy that capital. But
but we saw with the DeepSeek thing, they're not honest about how much money they threw at it. They obviously copied the whole thing. But, I mean, I don't know. Maybe I'm not advocating.
Well, I just think that if you're
copy ChatGPT,
I just think that if you're already behind, these companies, I think it's wrong to assume that you can just spend money to catch up.
Yeah, but that's what they've always done.
Yeah, I don't think it's going to work with this though.
I
mean, it could. Maybe if you buy some.
Siri has been, people have been complaining about Siri for a long time. Siri was the company they acquired actually. So this didn't even originate within Apple itself, but this was a company, and now Siri's lighting up because I'm talking about her. She'll probably give me wrong directions today or something because I'm make her mad. Yeah, but I just think they need to step up their game. So their earnings is going to be this week. I'm going to be interested to see that. But a couple of the other things we have coming up, obviously we talked about Target with consumer confidence. That data is going to come out this week. Durable goods orders will come on the 28th. That report is going to reveal how much businesses are investing in like large ticket items. So we look for strong durable goods number to signal that business confidence and a healthy economic outlook is kind of bubbling on the horizon. So any weakness here could kind of indicate something similar to the 10-year yield, which is that future growth may be a little anemic. And so the interesting thing would be to see what the 10-year yield does this week, especially in light of all these metrics that we're getting. And then February 28th also is going to have pending home sales. So how many homes are being sold? Not a lot.
Yeah, I'm going to say
the average age of a home buyer in this country now is like 54 years old, which is not good. This is not a sign that you want. And the Trump administration knows that. They're going to try to do everything they can to change that. That's why Trump is talking so much about the 10-year yield.
Yeah, you got to have it. And they're real estate dudes. They get that and they understand it. And, but yeah, in short order, everything that we've seen develop since the beginning of the year has led us to believe what we believed at the beginning of the year, which is things do look optimistic. There will be some market excitement that comes up, and that doesn't mean good or bad. That's just there will be volatility. Yes, weakness. So, but all in all,
you're right. He didn't mix this well. Shaking this around, it's all at the bottom.
Don't show the name brand on the screen. I'm going to get a cease and desist order.
Local. It's a local brand. Yeah. So I think that's absolutely right. Volatility is the name of the game here. It's going to be kind of ping-ponging back and forth. But we are hoping, all we can hope is that to go a little bit higher. And then we had market highs not last week, but the week before that, market hit a high and it dropped back down. So as long as we start to see, hitting levels of support and then bouncing back off of that, that's a good sign. That's what we don't expect markets to go straight up all the time. We do want some opportunities in there. We need opportunities in there, particularly if we're doing rebalances, which will come up on in a few days here. We might have a little bit of a rebalance.
And for new clients too, we have millions of dollars of new assets coming on here that's in the pipeline. And it's great to have these types of opportunities, these periods of weakness for those new dollars to come into the market. And it gives people that may have missed a good run up an opportunity to get in and to have kind of a near-term expectation for gains. Doesn't mean it's always going to happen, obviously.
And it doesn't mean it's not necessarily something you have to wait for either. If you're retiring today from your company and you want to do a rollover into an IRA or something, you shouldn't wait for a downturn in the market to do that.
Oh,
that's
no.
Productive.
I think that if it happens while you're doing it, that's just it's
icing on the cake.
Icing on the cake. It's good for you depending on where you're coming from, right? If you're coming from cash or coming from
a lot of those
different investment strategies than what we do.
Yeah, a lot of those are going to be coming from like broad indexes, like S&P 500 fund and stuff.
You shouldn't let it bother you. Just like you said, it's icing on the cake. It's a little bump to start your retirement. So don't let that. And that's when you can't really look too. I mean, you can pull if you ever get concerned about whether or not you should or should not be investing. Go back over the last 20 years and look at the S&P 500 and tell me at what point in time was it a wrong idea to get invested.
2008,
and then compare that to now. I mean, right? You go back and say, well, here is the high of October of 2008.
Yeah.
Okay, well, I'll take that because look where it's at now. 2009 and 2010 it's not fun, but even if you got the timing wrong every single time and you go back over a 10, 15, 20-year period of time, it's fine. It's perfectly fine. So
yeah, I mean, that's crazy. Looking at this is insane because you go to the 2008. So you go to the 2008 high, which was August of 2008. And I'm looking at the SPY, the ETF, Spider ETF. Mm-hmm. Price was 128.79.
Today, what is it?
Today,
600.
599.39. Yeah.
So you got a 5X almost for those that like to crap on us in the comments section. Almost got a 5X. I don't have to be specific here. You almost got a 5X.
Yeah, that's actually a good point because we do have some activity going on in the comments and especially on the little shorts that we put out as well. So I will just say that this conversation that we have is one that we've always had between ourselves. We just decided over the last few months to put microphones in front of us so that we could kind of share it with clients really and then everyone else ultimately. But this is not a time where we're like having an hours long deep dive into a specific.
No, this is top of mind, fast moving. It's taking the same information most of you would be exposed to online on CNBC and then giving you our perspective because our business revolves around this.
Right. So it's not taking a deep dive and looking at every single aspect of an idea with a fine tooth comb. We're going to miss some things. We're going to not talk about certain things that maybe have an effect on it. Maybe the 5 things that we say affected the market last week, maybe there's a 6th that's maybe of equal or less importance or more importance, and maybe we missed that. But those are the things that's going to happen. Our job here is to bring sort of clarity to a situation as we see it, which is what happened in the markets last week, and then what we're looking for this week. Is very simple. What was and what will be.
I've got to say it.
What could be.
I can't not say it. So we're not going to respond to all the comments. Garrett gets on there and does respond to some, and he does a great job of cleaning up the scam stuff.
Oh yeah, we got a scam comment on the crypto
scam video.
Scam video.
So, but I will say, so I spoke briefly about Milton Friedman. I didn't come up with this idea. He did. Okay, much more intelligent than 99% of anyone in America. So he came up with the idea. What if we just simply put our monetary policy, replace the Fed with a computer at a 2% inflation rate? And he pontificated as to what would happen. He predicted good things would occur. Now, that has not been done, so we haven't experienced that from a central bank. But there is someone that basically did what he said, and it's called Satoshi Nakamoto, and he created
Jack Dorsey.
Yeah, he created a $2 trillion asset called Bitcoin. So Bitcoin is programmatic monetary policy. That is what it is. It's been done in the private sector. So everybody wanting to act like it's some stupid idea,
well,
it's a $2 trillion asset.
Everybody. It was
no, one person that was very mean, very mean, and I was like, "Come on, man, it's ridiculous. Go do something else."
All right. Well, I think that's a good place to end it. Anyway, this week, to wrap it up, we're looking at a mix of inflation data, consumer confidence, some sort of business investment trends. We talked about interest rates and how the market is sensitive to that and sort of how that goes and how that plays out. So, our key takeaway is just we focus on the bigger picture. That's what we always do. That's what we talk to our clients about. We're looking at the long term. We're not looking at the short term. It's interesting to look at the short term and kind of give commentary on it, but we are in this for the longer term. And even if you're going into retirement, you should be also in this for the longer term. It doesn't necessarily change just because you turn 55 or 60 or whatever your retirement date is. Because in all likelihood, according to life expectancies, unless there's a specific thing there that's going to shorten your life expectancy, you have typically at least as long as you've had in working years in retirement. So that's not something that we see often changing. It's sort of a misconception there that you should get super conservative when you get into retirement. It's not necessarily the case. Again, caveat, asterisk here, speak to a financial professional, run this along those lines, but everybody's situation is different. But that's just something we see sort of across the board. Anyway, if you have anything else, if you don't have anything else, that's been Momentum Mondays for this week, the week of February 24th, 2025. Yep. And we will see you next week.
That's a wrap.
That's a wrap. We'll see you next week. Next week, we're going to break down the takeaways from February's PCE numbers. We'll talk a little bit about that, what that means, and what we think that means for the future. Looking forward. Peace. Anyway, that's all for us. So we will be here next week. Have a great week, and we will see you on the flip side.